morning and welcome to the Bank of Zambia, ladies and gentlemen. As Franklin mentioned, you're tuned into the Monetary Policy Committee press briefing live on Facebook and ZNBC TV 1. My name is Nkatia Kabwe and I'm Acting Assistant Director for Communications, and it is my pleasure to be your host for these proceedings this morning. Ladies and gentlemen, please allow me to introduce the high table before we proceed. Seated right in the middle of the high table, we have the Governor of the Central Bank of Zambia, Dr. Denny Kalyalya. On his immediate right-hand side, is the Deputy Governor for Operations, Dr. Francis Chipimo. On his immediate left-hand side, we have the Deputy Governor for Administration, Ms. Reka Mohango. On Deputy Governor's immediate left-hand side, we have the Director for Economics, Dr. Jonathan Chipili. And on the far right-hand side of the table, on our right-hand side, we have Ms. Gladys Mposha, who is the Director for Banking Supervision. And last but not least, right next to her is Mr. Isaac Mohanga, who is Director for Financial Markets. Ladies and gentlemen, this is the moment you've been waiting for. Without much further ado, I'd like to call upon the Governor, Dr. Denny Kalyalya, to give his keynote presentation. Governor, sir.
Thank you very much, Katia. Let me welcome our colleagues from the media to the Bank of Zambia for this presentation. Good morning, everyone. The presentation is organized in 16 parts. I'll start out with the decision of the Monetary Policy Committee, followed by global economic growth, domestic economic activity and outlook will follow. Then I'll look at the inflation outturn and outlook. That will be followed by monetary policy or monetary operations. Then we look at the measures that the bank has taken since the COVID-19 started. That will be followed by a brief look at the government securities market. We'll look at the developments in the interest rates, followed by domestic credit developments. We also have just a short presentation on the money supply situation, followed by fiscal policy issues, and then we look at the foreign exchange market. Then the 13th, we'll look at the selected commodity prices, and then we'll look at the current account, which is the external sector, to be followed by gross international reserves, and then I'll provide a conclusion. Moving on to the first part, which is the decision of the Monetary Policy Committee. At its meeting, the Monetary Policy Committee, which was held between the dates of 17th and 18th August, the committee decided to reduce the policy rate by a further 125 basis points to 8%. This is quite a steep cut. If you recall, the last time we met over this matter, we reduced the policy rate by 225 basis points. So we have decided to reduce it by a further 125 basis points, bringing it to 8%. Now, you may say, why this big decision? There are a number of factors that the committee took into account. Notable among these were the following. We felt that we needed to safeguard financial stability, people's lives and livelihoods in the work of this COVID-19 pandemic. You will see later on that Zambia is no exception in here. Secondly, we looked at the projection and observed that over the forecast horizon, which is 8 quarters going forward, which is up to second quarter 2022, inflation was projected to steadily decline and to move towards the medium-term target range. And in fact, to the very end, we see it touching the upper bound of that target range. Thirdly, we noted with concern that the economic conditions during the second quarter have actually worsened. We see that the prospects for growth, even the rest of the year, are quite weak. You will note later on what that really means in the figure terms. So To underpin this presentation, look at the global economy, which we have observed, and I'm sure you have also seen from other publications, that the global growth is now projected to significantly decline by 4.9% in 2020, which is a downward revision from what the earlier projection was, which was a negative 3%. This is largely reflecting the deeper and the more protracted negative impact of the COVID-19 pandemic. What we have observed, and the others have too, is that the measures that have been taken to contain the pandemic are severely constraining private consumption, investment, trade, and travel, resulting in weakening global demand. As a result of this, we see that output and employment have fallen quite drastically as manufacturing activity has declined sharply due to supply chain disruptions and factory shutdowns. The services sector, particularly transport and the tourism subsectors, have continued to be the most adversely affected. I'm sure you are all aware that airlines, only until recently, even here in Zambia, were not coming in or going out. So that has really created a lot of challenges to the tourism sector, and that means job losses at the same time. These growth prospects remain quite subdued. What is seen is that over 2021, it's going to recover. The global economy is projected to recover, but at a reduced pace than was earlier projected. Earlier, it was projected that it will bounce back to 5.8%, but now it is projected that it will recover only to 5.4%. Now, this is on the back of the measures that governments and central banks around the world are expected to undertake to support this recovery. I think the chart on the right-hand side of the screen tells the story in figure terms. What you observe is that the solid red line there is showing what the world global output was. Now, pre-COVID is the blue line there, which shows that actually the global economy was steadily moving, though not strongly, but at least it was in the positive range. But when COVID-19 came in post-April, this is the red line that you see, the dotted line. You see that it was a dip of 3% that I mentioned earlier on, but now we are looking at 4.9, and then this is moving. It's a very interesting looking chart, but it has a lot of meaning behind that. Now, even though growth is projected to rebound, there are still a lot of uncertainty that surround the forecast. A lot will depend on how the pandemic itself evolves, as well as the speed at which a vaccine and the treatment of all of us will take. If that takes long, that means that the opening of boundaries and the institutions will continue to be constrained. Now, coming here back to our own domestic economy, as I indicated at the beginning, what we observe is that as at yesterday, which is August 18, I'm sure I've been following up the updates by the Minister of Health, COVID cases in Zambia have risen to 9,981. At the time of our previous announcement, which was on May 20th this year, the cases were only 832. You also, if you are interested, look at the number of deaths that have occurred. At the time of that meeting, I think we had about 7 deaths, reported deaths, but now we are talking over 200, about 264. So that's quite a big and a very concerning development. So what we underscore is that the rapid rise in the cases reflects the severity of the pandemic, and this has had a telling effect on domestic economic activity. This has worsened in the second quarter, as reflected in company shutdowns, job and income losses, declining business output, and weakening consumer demand. I'm sure these days it's not uncommon to find among us here who knows somebody who is not working, who has lost an income, who has lost something. So this is quite strenuous and a very tragic development. Our own publication here, which we call the second quarter 2020 Bank of Zambia quarterly survey of business opinion, indicate worsening economic conditions, with all monitored indicators showing deterioration, except for new orders, which again, when you drill down, is only because of the demand to fight the COVID-19 pandemic. Equally, the Stanbic Bank Zambia Purchasing Managers Index indicates significant deterioration in business conditions for the private sector amid the company shutdowns, decline in business output, and weak demand. For our economy here as a whole, it is projected that it will contract by 4.2% during 2020. This is a deeper reduction than was previously projected. Previously, we had projected negative 2.6. This is against the revised preliminary outturn of positive 1.4%. In graphic terms, this is what you see. You see that the initial projection was this blue dotted line. It was going to decline to 2.6, but now it's projected that it's going to decline to 4.2%. So recovery is expected to happen, again, dependent on how the other variables behave. So the substantial decline in consumer demand, consumer and investment spending due to disruptions in business operations are expected to continue to constrain economic growth. The most adversely affected sectors in our case are wholesale and retail trade. As you expect, these are cross borders. Some of them, they are not able to move. Construction and, of course, tourism. Then we look at the inflation outturn and outlook. What we observe is that annual overall inflation continued on an upward trend, rising to an average of 16.1% from 13.5% in the previous quarter. We show this on the figures 3 and 4. Here, 3 is this one here, which we show in number terms. But I think the more revealing part is this figure 4. What you observe, you see the sharp change here in the fourth quarter going into the second quarter of this year. You see the red line, this is the non-food, and the green one is the food inflation, and the middle line obviously is the overall inflation. So what we are saying is that you can see this sharp upward movement in inflation during the second quarter. What we observe is that the major driver for this outturn was the depreciation of the kwacha, and some of this is lagged effects, but there are also some what we call contemporaneous effects that happen to inflation. In July, however, we note that inflation marginally went down to 15.8% from 15.9%. Yeah, you might say, well, that's just a 0.1 percentage movement. It's very important. The direction of change is an important indicator of the underlying dynamics. This reduction is attributed to reduction in prices of maize and related products, as well as for seasonal vegetables. Although projected to remain above the upper bound of the 6 to 8% medium-term target range, inflation, as I indicated, is expected to steadily decline reaching the upper bound by the end of the forecast horizon. Expected moderation in food prices due to the significant improvement in supply of food items, particularly maize, is assumed to be the major driver. Factors that are keeping inflation above the upper bound of the target range in the earlier part of our forecast horizon include higher fiscal deficits and the weakening of the global economy, which I articulated earlier on. There are indeed some still risks to this inflation outlook that we are projecting. One is that there could be further deterioration in the fiscal deficit. There could be some adverse impact coming out of the monetary expansion arising from the reduction in the policy rate that we are announcing today and we announced previously, as well as some other measures we are taking in the financial sector. There could also be a deeper than projected global recession, as well as prolonged and extended electricity load shedding. So all these, if they come to materialize, it means that inflation could actually go up. But for our part, we stand ready to do what we deem is appropriate. These various risks that we are highlighting can come through either through the interest rate channel, they could come through the expectations, or indeed through the exchange rate channels. Monetary operations. To try and manage the inflation and the policy rate, what we observe that the interbank rate, the overnight interbank rate, declined to a quarterly average of 10.98% in the second quarter from 12.56 in the first quarter. This followed, obviously, the reduction in the policy rate that we announced in May. We see also that there had been marked increase in liquidity, largely on account of the broader set of measures that we instituted to mitigate the adverse impact of the COVID-19 pandemic. Let me just show you before I come to the measure, this is the chart which we often show. What you observe is that the green line, this is the interbank rate, and the stepwise, that's the policy rate. So what we are showing is that this has dropped, especially after the May announcement, and it's within the corridor of plus or minus 1 percentage points around the policy rate. Now, these are the range of measures that we undertook since the onset of COVID-19. One of the measures was the scale up in open market operations, which is what we are saying contributed to the increase in liquidity. We also introduced the targeted medium-term facility, the 10 billion facility. We also introduced the secondary market bond purchase program. All these are injecting liquidity into the system. Of course, the 10 billion facility is not moving at the pace we had anticipated, and we'll be looking into this as we move forward. We also revised the rules governing the operations of the interbank foreign exchange market. We made revisions to loan classification and provisioning rules. We extended the requirement of mining companies to pay all their statutory obligations in US dollars. This has been in force since June this year. We initiated arrangements to engage domestic and the non-resident financial institutions in foreign exchange swaps. We stepped up the sensitization on the use of digital channels and the contactless mobile payment mechanism. And finally, we implemented business continuity protocols. So this, let me move to the next segment. Continue with the monetary operations. This is the chart we normally share with you, just to bring home all these different influences on liquidity. You heard me say that open market operations, this is the line here. You can see that that's the major contributing factor here, 2.6 billion kwacha during the second quarter. I said also foreign exchange purchases, which we made through these receipts of tax obligations. We see also the issue of net government spending on the other one, securities rather, it was withdrawing. Then net government spending, this in a long while was a positive, which is what you normally expect, that the government, when it spends money, it circulates in the economy. I think this was to do with the clearance of some of the arrears that we have been talking about. We now look at the government securities market. This market has been very active during the second quarter, partly because revenues have declined, obviously due to COVID-19. The Minister of Finance and their colleagues at ZRA have been making those pronouncements to share with you that there have been shortfalls in revenue collection. So the government needs, on the other hand, haven't subsided. If anything, they have gone up. So where does the government raise funds for those kinds of activities? So recourse was made to the securities market. So what we see here, because of those increased activities, there was in the auctions a significant increase resulting in a surplus of 3.9 billion kwacha. And we see that the subscription rates, especially on the treasury bills, increased markedly to 168%. For the bonds, it increased, but not to the same magnitude, to 39% from 27%. So if you look at this, this tells the story of the securities market, what was happening. The brown lines shows the funds that were raised through the auctions, and the blue lines show you the maturities. What you see that in the second quarter, it was, and there were huge maturities that were to be financed, which meant that the government had to issue more securities. That's why you see that this huge movement here in the funds raised. And as a result, we got a surplus. That's the 3.9 billion that I was referring to earlier on. So this shows some heating up in the securities market. And that is something that we are watching along with the Minister of Finance as to how it plays out. Now, looking at the various components of that, but before doing that, let me just say, because of these increased activities, we see that the outstanding stock of government securities increased by 18.4% to 102.5 billion kwacha at the end of June. And we see that the holdings of these securities by non-residents also increased by 4.2% to 13.2%. We highlight this also to indicate that they underlie some kind of risk in that when they change their minds, they could want to take that money out. So that puts pressure on our reserves that we have. So that's why we pay particular attention to this. So it's a double-edged sword. So on the left-hand side of the screen here, you see that we have the various, the two types, not various. The treasury bills are in blue and the bonds are in brown. So you can see that the bulk of the securities are in bonds. But what you observe too is that in both instances, treasury bills and the bonds, they increased in the second quarter. On the right side, this is the story of the non-residents, where we are showing that 13.2 billion of that is held by non-residents. The bulk of that, literally the whole amount, 97.4%, is in government securities. Before leaving that, I should also say that quite apart from the auctions, to raise this to that level, we saw some issuance of private placements to augment the auctions, because the auctions alone were not sufficient, did not sufficiently raise the funds that the government needed. Then on the interest rate side, we see some encouraging movement that these were declining, particularly on the lending side. So what we see here, though, is that the composite for the bonds, the green one, is the one which rose quite significantly. You can see that. But if you look at this, which is the weighted average lending rate, it was declining in the quarter under review. Still high, but at least it was declining. Then when you look at this is the interbank rate, which I referred to earlier on. The policy rate, you see that is near that, as should be expected. So the bond rate, as I said, is one, I think, which has gone. But why is this happening like that? What it means is that it's kind of holding some information here in terms of the perception of the investors. It means that the investors are looking at the longer term units as being risky. So what we are saying is that the government bonds, the participation there, these are people who are taking high risk premium on long-term proportional growth in the credit that was observed in the quarter under review. Money supply, what we are saying here is that in spite of the expansion in the credit to government, money supply year-on-year slowed down to 29.4% in June from 31.6%. But you recall I said that there is that risk that we are still attaching to that. Should it suddenly expand more than the production in the economy, it could bring out some inflationary pressures. So we remain watchful of that. So this is just a graphical display of those changes that I've referred to. Fiscal policy. The ongoing fiscal spending pressures, as we have previously pointed, were compounded by the measures that were needed to be taken to contain the COVID-19 pandemic. At the same time that this was happening, there was a sharp drop in the government revenue. So this tension is quite a challenging one. So in the light of the high external debt and expansion in domestic borrowing, to bring the fiscal deficit to sustainable levels has become even more challenging. So this is something that we have to pay attention to. So what we are saying that to restore macroeconomic stability and achieve sustainable economic development, urgent macroeconomic adjustment measures underpinned by fiscal consolidation and the restoration of the debt sustainability remain imperative. So this is something which we need to be on the lookout for, because for us to see growth on a sustainable basis, we need to really rein in these challenges. In the foreign exchange market, what we see here is an interesting development. You note that in the first quarter there was quite sizable pressure, as shown in the chart on the right-hand side. The kwacha moved quite quickly to more or less settle around 1820 kwacha to the dollar, but the movement from say 14 kwacha to the dollar was quite rapid, and that is depicted here. You see all the charts here, like this red one, that's the dollar US, the dollar kwacha relationship. You see this surge in the movement of the exchange rate, but once it hit this 18 kwacha to the dollar mark, we see it kind of settling around there. So you see it coming down slightly. Of course, currently there is pressure in the market because supply has been constrained. So this is a matter which we are looking at very closely and to see what we can do to moderate that movement in the exchange rate. So here, really what we are saying that this pressure is important to observe because movement in the exchange rate also finds expression in inflation that we are talking about. Now, supply, as we said, as I indicated, was quite constrained in the second quarter. If you look, traditionally, the mining sector has been the major supplier. So if you look, the blue line, that's what it was in Q1, and the brown one, this is what it was in the second quarter. So you can see that there has been a decline in supply. There has been a slight decline also on the demand side, but not to the same extent as on the supply side. So this is a challenge that we have to face as a country. We have always said that we need to diversify our sources of foreign exchange. Depending on one commodity predominantly is not a good thing. So we really need to up our search and implementation of measures that can help bring the stability that we are looking about. I'm sure many of you, as you go around shopping, the prices of many commodities have gone up, and they are citing the exchange rate as the factor behind those movements. So how long should we continue saying that without us stepping in to meet some of that demand that we have? On the commodity side, these are the commodities. What we show is that, you see, look at copper. Copper prices reasonably high, but you see that in the second quarter they declined from 5,634 per ton to 5,351. Oil prices also, for those who are exporting oil, this is quite a significant decline. Although for us who are demanding oil, consumers of oil, we feel this is good because we expect that the fuel prices would come down. But for the producers, it's the other side. We see wheat prices also coming down, maize prices equally came down, cotton down, sugar down. So literally all these commodities were showing signs of decline because demand for many of these things have come down, and hence the lower growth that we are seeing globally and here in the domestic economy. Now, the external sector, we see that there is a surplus, although it narrowed in the quarter under review. We see that we have 210 million. But when we look at this, the drive of that is worrying in the sense that it is arising from deficits on the primary income, which means that the loss making is giving a surplus. So you cannot rely on that as being sustainable. But for accounting purposes, there is a surplus, but it's a technical surplus, if you will. Now, what you want to see here, you see that the current account balance, this is the one, the top line there. But if you look at the goods exports, you see they have come down from 1673 to 1626. Look at the imports. Imports have also gone down very significantly. So as we point out later, because of this decline in imports, our import cover from the reserves that has gone up. So we can't really say we are comfortable with that situation because it's arising out of constrained demand, which shouldn't be the case. Okay. There you are what I was talking about, gross reserves, that as at end June 20, gross international reserves increased to 1.43 billion kwacha, which is equivalent to 2.3 months of import cover. This is shown here. What is important though to note is that you see it was a steep decline flattened, and now it's moving up. But would like this really to be well above this. That's where the diversification story we are talking about. So we can't stop saying this until we see it happening. Now, in the quarter under review, we did also take some measures where, in addition to mineral royalty tax, ZRA and the government agreed to request, and the mine companies agreed to be paying their statutory obligations in US dollars. So this started in earnest in June of this year. So we are continuing to do that going forward. Now, to conclude, what we are saying that with all these challenges that you have seen, it left us with no other decision but to really try to protect lives, to bring about financial stability, because if these challenges are accompanied by financial instability, the challenge will even be worse. So we feel that it was necessary to lower the policy rate to the extent that we have done. The inflation also is projected to come down. We are hoping that going forward there will be more activities which will improve the supply of food items. So we are hoping that with this movement and the actions of other players in the market, I think we can try to weather this storm better. But obviously, this on and by itself will not get us out of the challenges that we are facing. So we call upon others, as we did in the last time, that we need to join hands and do what we need to do in our respective areas so that we can get our economy moving again. So I end there and thank you. God bless.
You're watching the Bank of Zambia Monetary Policy Committee press briefing, coming to you live on Facebook as well as ZNBC Television, TV1. We get straight into the question and answer session, and so we'll be opening up our floor to the journalists who are present here today, representing various media houses from print, television, radio, and online. So just some housekeeping rules for the journalists in the room. We will only be taking 3 questions at a go for each round, after which we're going to allow the governor and his team to respond to the questions. And please also would like to request that you limit your questions to only one in the interests of live television, and also please be as brief as possible. So we'll take our first 3 questions. Please do let us know your name and the media house you're representing.
My name is Elias Shlangwa from the Chinese news agency. It's the official news agency of the government of China. My question is, recently the Paris Club creditors accepted to provide Zambia, to suspend debt service to Zambia, and the Chinese government also said it will consider doing away with the interest payments on China's government-to-government loans. So I wanted a comment from the government, from the governor, and what does this mean to our economy?
Thank you, Elias. Next 2 questions, please.
Good afternoon. My name is Joseph Tamaribanda from QTV and QFM Radio. Governor, we have noted that BOZ is caught up in between the hard press and the rock. I wanted to get your quick recommendation to the spending agency with regards to resuscitating the economic activities. What should the spending agency do during this era of COVID-19 to ensure that the economic activities are resuscitated? Thank you.
Thank you, Joseph. Last question, please.
Thank you very much. So my name is Esnat Lungu from Spring 24 TV. My question is, the Bank of Zambia has been trying to they've been trying to help inflation to remain within the 6 to 8% target bound, but this has obviously not been the case, considering we're now at 15.8%, and now the policy rate has been reduced with a projection that inflation is going to be drawn towards the 6.8 target range. What are you doing differently to ensure that that inflation rate is at least brought to that target range, considering that previous efforts have only proved otherwise? Thank you.
Thank you very much. So thank you. Then we'll hand over to Governor in the boardroom to give his responses to the questions. Governor, sir.
Thank you very much to the journalists who have raised questions. The first question by Elias, I think we can only talk periphery on the sidelines here, because this is a matter which the parent ministry is handling. But I think to the extent you are asking what the implications of the Paris Club decision and the Chinese government delaying debt service on our part, I think these are positive developments. You have noted in the past when we are talking that debt service was one of the major challenges we were facing. So with the low reserves, I think it's a positive thing that the low reserves that we have then can be deployed to other uses which are very, very critical. So on the whole, we are saying this is a positive development. We hope that actually it can be for a much longer period rather than just to the end of this year. But as you know, there are advisors that the government engaged to help in the liability management. So we await the outcome of those negotiations. But in terms of the implications, for us, we think it is a positive, it's a move in the right direction. We hope that other creditors will quickly also follow suit and give us the relief that we urgently need. I hope that answers your question, Elias. Joseph from QTV, you are trying to find out what advice we can provide to a spending agency. Now, you are also a spending agency, by the way. So we are all spending agencies in one way or the other. But I guess what you are trying to get at is what is the fiscal. I think if you look at our statement or even the presentation that I just made, I think we are saying that, these are an unusual times, and the minister also is on record pointing out that fact. So we need to really prioritize our expenditure in ways that will help us save lives, get the macro stability coming on board, so that once we are through with this COVID-19, which obviously it will come to pass at some point, we are in a position to get growth of our economy going. Growth is not only for its own sake. As we have said, this pandemic has devastated people's lives. Incomes are lost, purchasing power is not there, businesses are closing down. So this is something that we need to really pay attention to and think very carefully for every kwacha that we raise, be it from revenues, be it from government securities, is well spent so that it brings the benefits that we so dearly need. So I think that's all I can say, but I think in the presentation we do make that statement very clearly. But perhaps my colleagues here can also augment my question. I'll ask the DGO to see if he can say one or two things as well.
Thank you. Governor, on the fiscal specifically, or maybe I'll maybe just move to the SNAT's question, perhaps on inflation. Yes, it's true that the tension we face of trying to deal with the challenges of COVID, while at the same time trying to address the challenges we face with inflation, does present really homework for us. But I think if we go back to the previous MPC statement which we had, I think what you will note is that when we were describing the increase in inflation, we were making reference points to really two driving factors. One was we saw food inflation rise very, very strongly, and that was due to obviously past challenges on the food side. But more importantly, we had seen non-food inflation rise relating to the increase in fuel in December and earlier in the year. And at the time, what we were saying was that we thought that given the good harvest, food inflation would begin to drop, and that would help us. And obviously, on the non-food side, what happened on the exchange rate was going to be an important factor. What we're seeing going forward, and in this forecast, what the governor has just alluded to, is the fact that on the food front, we've had a very good crop in the current season, and we expect this to really drag down food prices. So in that sense, one of the big drivers of inflation in the past now seems to be abating. Obviously, the issues around non-food inflation and the exchange rate remain an area of concern, and that's something, as the governor said, which we are looking at in terms of how we manage the foreign exchange market. So the deeper question is really, the governor has made reference to the issue of really focusing on COVID, the impact it's having on lives, the impact we've seen it's having on GDP and the contraction in the economy. I think we're really seeing unprecedented numbers, not just globally, but actually domestically. And I think that's really raised that concern to the top of the list of issues we really need to address. And hence, really, the past two aggressive reductions in the policy rate, which have been undertaken. We still are keeping a close eye on inflation developments over the medium term. And as has been mentioned, we now expect that at the end of the forecast period, the second quarter of 2022, we should see inflation coming back down to the target range. So we will continue to obviously observe the risks, and we always stand ready to take appropriate actions if we see inflation really not going in the direction within which we now expect it to move.
Yes, no, thank you very much. Maybe to put it in plain language, one of the things we have observed that inflation is driven really, there are two ways in which you can look at it perhaps. One is say that sometimes there's too much money chasing too few goods. The other time is you can say that there is a limited supply, so that's why you are getting that. So what we have observed as the Deputy Governor say, supply side factors have been a major challenge to inflation for us. So as he said, what we are trying to do with this lowering of the policy rate is really to try and help galvanize aggregate demand so that there is some supply of goods and services. So it's not a battle for us alone. That's why we are calling on others to join in to do that. Otherwise, the traditional tools that we have of managing money supply will not do when inflation is driven by supply side constraints.
All right, thank you, Governor and team, for those responses. Can we take the next 3 questions, please? And just a reminder to be as brief as possible and keep it to one question. The lady.
Good afternoon, Governor. My name is Gladys Luizi from the Zambian Business Times newspaper. I want to drive you a little bit away from the policy rate to developing gold reserves. We had reached out to the bank in May this year, where we wanted to find out how far the establishment of gold reserves has reached. And you told us exclusively that you had already advanced negotiations and you had submitted a contract to an identified supplier who's going to govern these gold reserves. So we want to find out how far this process has gone, as well, if you could as well just disclose who this supplier is. Thank you.
Thank you, Gladys. Next question, please.
Good afternoon, Governor. Taonga Mitimingi from Bloomberg News. Is there enough investor capacity to absorb government's increased issuance? And how much further capacity does the central bank have to buy government bonds before it gets too risky?
Thank you, Tonga. Last question.
Good afternoon, governing team. My name is Brian Mwale from ZNBC. I just want to find out on should people really be excited, people that are currently servicing loans with different banks, should they be excited about the reduction in the policy rate, hoping that maybe they can have their disposable income increased through reduction in interest rates? In a nutshell, is that 125% basis point reduction in the policy rate enough to trigger a reduction in interest rates? Thank you.
Thank you, Brian. Handing over to Governor and team to respond.
Thank you very much. Sorry, Gladys, I didn't get the affiliation in, it was a bit muffled. What? Zambia Business Times? Yeah, on the status of the gold reserves, you know, this COVID-19 is, the pandemic is operating in different ways. We had thought we had made significant progress, but it's constraining some of the parties that we are involved in. I don't think it's a secret. We had disclosed who we are discussing with last time, and I think it's the more formal producer of gold in our country has been Kansanshi Mine. That's the one, but there are others now who are coming on. So we are excited that we even had a meeting with the new general manager. I think you met him, some of you through your various interactions. So he undertook also to look into this matter. So we are still pursuing it, but obviously there are some communication challenges which COVID-19 has brought to bear, but the process is underway. Definitely once we reach that point where we are transacting, we will be the first ones to know. So for now, the process, all I can say, is underway, and we see that the government also is mobilizing other possible producers, and we will be engaging those as they come online. I hope that satisfies your question. Tawonga, investor capacity to buy bonds. You know, the sale and the purchase is a two-way street. You can only sell what is being able to be absorbed. So I don't know when you say is there enough investor capacity to buy these bonds. I think that could be best answered in the context of is there a target that we are looking for to raise? But as you have seen from the information that we have shared with you, the auctions have been well subscribed in the sense that we have been able to meet the maturities that are going on. But obviously the needs of government are immense, and you could want to do, but remember, this is debt also, it's not free money. So one would hope that you raise more revenues than going through the debt route. So it's a tricky question you have raised, and I'm not sure I'm in a position to give you a satisfactory answer to say that yes is enough. But what we are seeing is that there is some response from the players out there, the investors, to buy, but they are also mindful of the challenges that we are all facing. So it's not limitless, so to speak. But for now, we are trying to manage that as much as we can. Then on the capacity of the bank to buy, I think we have, as it's a program that we laid out. I think when we said we are going to engage in this, we had a target number, which was the 8 billion. And I think that's we were within our capacity. That's the bond, secondary market bond purchase program. So that is contained, it's very specific, and we are in a position to meet that. So I hope that answers your question, but if you not, you can follow it up with another question at some point. For Brian's question on is the reduction in the policy rate enough. You know, the fact of the matter is that when we reduced the policy rate by 225 percentage points last time, the same question was being raised. But I think we have gone on to see that immediately we did that, the number of the banks whose lending rates are attached to the policy rate actually did reduce by the same margin of the reduction that we have then. But obviously, as a borrower, you would want even lower rates, but it's a tussle because the banks also, on the other hand, that's where they make their living, the profitability is in that. So it's a challenge. You will note also that in the 10 billion facility that we announced, one of the key things we have put as a condition is that the people who access that facility must actually benefit from the fact that the interest rate is low. So that we have reduced the policy rate to 8%. It means that those who access from here on will be accessing it at that lower rate. So the answer to your question is yes, it's enough to trigger that change in interest rates. And I'm sure you have seen in the presentation that I've made here that interest rates save for the composite bond rate have come down. I'm sure you'll say, well, 2 percentage points is not big. But the fact of the matter, it is a reduction nonetheless. And it can only come down so much depending on the other factors that are at play. So yes, it will trigger some reduction. You may not be happy with it, but it will do that. And if we consistently do that, someday we'll be able to get a rate which you think is affordable. I hope that answers your question. Thank you.
Thank you, Governor. We'll take our last round of questions in the interest of time. So media, please, will come through.
Good afternoon. I am Jimmy Kanasha from CBC Television. My question mainly has to do with the issue of COVID-19. Hopefully, if it doesn't happen, looking at the fact that it might last a year longer or more, but in case it does, should we expect any further changes in the policy rates currently? And also another one would be, apart from looking at the issue of having gold reserves, what other forms of reserve are you considering to invest in? Thank you.
Thank you, Jimmy. Next question, please.
Good afternoon, Governor. My name's Michelle Malungisa from Zanis. For me, I just want to get an update following the directive by the Minister of Finance for the central bank to revise the modalities of accessing the 10 billion facility. I want to find out how far have we gone in revising those modalities. Thank you.
Thank you, Michelo. Last question, please.
Good afternoon, Governor. My name is Hope Musonda from MAN FM. I would like to find out how far the central bank has gone with the issue of legalizing village banking in the country. Thank you.
Thank you, Hope. Governor Sir, over to you.
Thank you very much. I hope Jimmy's prediction doesn't come correct, because we all want to get out of COVID-19. So really, we would dread the fact that if it is as to drag on for a much longer period, because it's devastating lives. But as we have said in our statement and in the presentation, that all these projections that we are making, they are surrounded by uncertainty, because no one knows for sure where we are going. So it's learning by doing. So for sure, and that's what we have said, that if the pandemic evolves in a particular way, we will adjust accordingly. So we can't quite upfront tell you what we'll do tomorrow. It all depends on how this pandemic continues to evolve. But God forbid, we hope that it will end soon, because it's quite very, very tragic that a lot of lives are being lost. Just look at our situation here. There's the kids. We already had a backlog of kids going to school. Now they are not going to school. So we are adding the number of people who are not going to school. That's not very healthy going forward. So there are many other challenges that COVID-19 has presented. And that's why I think we are taking the measures. It's not that we want to do this, it's because it's necessary for us to take the measures that we are taking in order to save lives and preserve livelihoods. So, as I said, we hope it won't continue forever. On the other forms of reserves that we consider, yes, there are other currencies we have our reserves in. Dollars is the manner in which we express the holding of reserves, but it doesn't mean that all the reserves are in dollars. Now, how you manage that is also a function of how your liabilities are. You hold reserves in the assets that can help you meet your obligations. So predominantly, many of our obligations are in dollars, and that's why we express it in dollars. But we do have some of the reserves in euro. We do have some in, euro is a big chunk of the pound sterling. So gold will be another one. We are considering also the renminbi holding, that is for the Chinese obligations. So, as I said, the way you hold reserves is dictated by your obligations, because you want to be in a position to meet your obligations as they fall due. Michelo, on the question you raised about the directive, this facility 10 billion, I think we explained very well that this is an initiative that the central bank took. This is on the balance sheet of the central bank. So indeed, we receive suggestions on how to look at that, but we are looking at how we can make it go far. So far, I think we have approved in close to about 5 billion in terms of applications, but disbursements haven't matched that approval rate. We have just over 1 billion in terms of disbursements. Now, others have suggested, why don't you give the money and then monitor afterwards? But our experience has been that if you do that, by the time you come to take account, the money will be used in a different way. So we are continuing to engage, and this problem hasn't gone away, as Jimmy has said. So we have to find ways, but we have also said that there are other measures that the government has taken which can address certain things. The 10 billion is just but one of the tools that we have. So we can't overload it with all the demands that we need to meet. So sensitively and prudently look at how this can be rolled out. Remember, it's not free money. Otherwise, if it was free, probably by now we would have dispersed it already. But we are also alive to the challenges that had emerged in previous facilities where the intended objectives were not met. So it's an ongoing thing. We'll let you know when we have made those changes which we deem will be appropriate. The village banking, maybe let me allow my colleague from bank supervision. Can you say something on this village banking?
Thank you, Governor. I think for now what we can say is that, of course, as a bank, we will be we are looking at the village banking issues that are taking place in the country. And we will be getting back to the public in terms of how we're going to guide them, in terms of how these village banking groups can actually operate. But I think what is important to note here is that village banking are actually supposed to be a closed group of people who come together in order for them to grow the money that they put together. And it's very closed, so they come up with their own conditions and agree. So I think, but what is also important to note is that you have to differentiate these groups from groups which are open-ended and which have got no basis for actually raising funds from productive sectors. So in terms of legalizing, I think the Bank of Zambia, we will be getting back to the public in due course. I think that's what I can say.
Thank you, Governor. The production crew here are quite gracious and have informed me that we actually have room for another 3 questions. So we shall take another 3 questions from the journalists, if that's okay.
Good afternoon, Governor. My name is Gift Inamba from Millennium TV. Mine is very brief, and it's just to find out the country or the country's current import cover. Thank you.
Thank you, Gift. Next question, please.
Good afternoon, Governor, once again. Joseph Tamaribanda from QTV. Governor, you did mention the aspect of money supply lowering, money supply is slowing down. How does this impact on the strategic plan, building an inclusive and resilient financial sector? So I want to find out how this impacts on this strategic plan that spans from 2020 to 2023.
Any other questions? That's all the questions we have right now, Governor. So handing over to you to respond. Thank you.
Very interesting. Thank you, Katya. So we had expected more questions. Gift, I think that is a simple question. Maybe it's already it's 2.3 months of import cover. I think one of the slides in the presentation you see, we do show that. In fact, I showed you that there was that curvature, it was coming down and then it's slightly, but I explained also that the coverage has increased mainly because our demand has declined. So it's 2.3 months of import cover. Joseph's question, it's a bit tricky what you are, I'm not sure I understand how this money supply and the impact on our strategic plan, which focuses on financial inclusion and financial stability. But perhaps what one can say that you note that the measures that we have announced today, in particular the reduction in the policy rate, as well as what we did in May, really is trying to help that space. Because financial sector stability, and I think I did stress at some point in my presentation that you want to have a resilient and stable financial sector. The challenges that we have will be dwarfed if we were to have an unstable financial sector. So money supply being low, it means that there isn't much economic activity going on in the economy. But we are saying that if that runs ahead of economic activity, it has also its own challenges in that it could do kind of induce inflation. So we have to manage this in a manner that we strike the right balance. But an economy that is growing needs liquidity because money is what fuels the wheels of commerce. So as of now, in terms of financial stability, I think the measures we are taking are aimed at anchoring that very strongly. One of the aspects is obviously the use of digital platforms which changes the relationship that we normally have with the money in the cash form. But that's a form of money nonetheless. In fact, much of your money is in digital form. So we are looking at different ways in which we can get financial inclusion stepped up. Depending on how things work out, we are this year actually undertaking a financial Fiscal just to gauge where financial inclusion is, and that also point out to areas where we need to do a lot more and where we have made some progress. So we hope that the emergence of COVID-19 will still give us space for us to undertake that survey. Maybe it will be done in a virtual form, but it's something we are looking forward to doing. Then on the issue of financial stability, I think I don't know if DGO, there is anything specific you would like to say in that regard.
Thank you, Governor. I think, perhaps just to add that one of the, and maybe just to reiterate the point you've made, which is that one of our concerns in the current environment has been how it would impact financial stability. And because the financial stability is so key to the performance of the economy, we were very clear that we should take measures which support that stability. One of them has been to try and provide more liquidity to the financial sector, and part of the easing of the monetary policy rate is really to help financial stability. So really from that perspective, our measures are very, very consistent with that concern which we've had on the stability issues. And so obviously, the more liquidity we think the banks have, at least hopefully some of the pressures which we've seen emerging can be ameliorated, as it were. Governor, I'd also maybe just like to come back on the issue of village banking and informal. I think it's important just to make the point that we do have institutions which are running under the name of village banking, but whereas in fact sometimes they are providing banking services or banking businesses which are regulated under the Banking and Financial Services Act. And those ones, we've been very clear, they are regulated services which must be done in accordance with the law. But of course, we do know that there are also these informal groups, and the intention is not to regulate all informal groups which are operating under village banking, as Director of Bank Supervision said. These are small groups of people who know each other, who are managing their money collectively. They're not, managing in the sense in which a bank operates and so on. Those ones, of course, we will be coming back and increasing the communication we give to the public in terms of, how they operate, how the public should be able to understand when they see some groups called village banking, what should they be looking for. I think on the communication side, we have committed to doing a lot more to inform the public so that they are aware that they are not participating in money circulation schemes or other such ventures, which will end up really punishing the public who invest in them if you're not careful. So just thought I'd stress that.
Yeah. No, it's actually very important, that issue, because people, especially in this environment we are in, people are stressed, and the little money that they get, they would want to put it into something, and someone will come promising that you get high returns. Our appeal to you is really to be very, very careful, because if it sounds not to be too good to be true, it may just be that it's too good to be true. So don't fall prey to that, because you'd lose even the little that you have worked so hard to earn. So it's really brilliant. That's, I think, the question which was raised on financial inclusion. That's one of the aspects we are trying to step up financial education so that people are well informed. If you allow me at this point, I can also indicate that the three of us, the three financial sector regulators, that is the Bank of Zambia, the Pensions and Insurance Authority, and the Securities and Exchange Commission, we are launched a drive to really to educate or get people be well informed on the services and the products that each one of us as institutions are regulating and overseeing. So you'll be seeing a lot more of us in the media space to try and disseminate information about what is happening. People don't know about insurance, but it's very, very important, especially in this time when you have these challenges. So I wish to thank you all for the opportunity to engage, difficult as it is, but it looks like this is the way we are going to be communicating for some time to come. So we thank you, colleagues, who are taking all the risks to come here and cover us and disseminate the information. So we encourage you to continue doing that. Thank you so much.
Thank you, Governor. Just to reiterate Governor's sentiments, we'd like to thank the media who are all present here today. You're all on the front lines in disseminating this very important information to the public, to the rest of the nation. On that note, ladies and gentlemen, we have come to the end of the MPC press briefing for Q2. On behalf of the Bank of Zambia, I'd like to thank you all who are joining us from whether Facebook Live or the ZNBC TV1 for joining us and taking the time to listen in today. For more information, just to let you know that both the detailed presentation given by Governor today as well as the monetary policy statement are all available on the Bank of Zambia website, which can be found at www.boz.zm. Once again, I'd like to thank you all for joining us, and also I'd be remiss if I didn't give a huge thanks to the production crew who are working tirelessly behind the scenes to make sure that this virtual broadcast went on seamlessly. So huge thanks to you all. And on that note, again, thank you all. God bless and stay safe.